Hey everyone, welcome back to Financial Market Insights for Traders, your go-to podcast where we break down market trends, trading strategies, and economic insights without the jargon. I'm your host, Sophia, and today we're diving into something every investor needs to understand if they want to take their trading to the next level, Macroeconomics 101. So, if you've ever found yourself wondering what is GDP growth, or how exactly does inflation impact my portfolio, this episode is for you. We're going to unpack the four essential macroeconomic indicators that drive markets: GDP, inflation, interest rates, and unemployment. We're going deep, no shortcuts, no summaries, just clear, actionable insights you can apply as an investor. All right, let's get into it. Segment 1: What is GDP growth? So, let's start right at the top with a basic but powerful question. What is GDP growth? GDP, or gross domestic product, is the total value of all goods and services produced within a country over a specific time period. Think of it as the ultimate scoreboard for economic health. If GDP is going up, the economy is expanding. If it's going down, the economy is in trouble. But how does GDP affect you as a trader or investor? Simple. GDP growth drives market sentiment. When GDP is strong, companies usually report better earnings, people spend more, and stocks often rally. On the flip side, 2 consecutive quarters of negative GDP growth, that's what we call a recession, and that can send markets into a tailspin. Now, economists measure GDP in a few ways. There's the production approach, which looks at output minus input. The income approach, which totals wages, profits, and taxes. And then the expenditure approach, which calculates spending by consumers, businesses, and the government. As an investor, pay close attention to real GDP. That's the one adjusted for inflation. It gives you a clearer picture than nominal GDP, which doesn't account for rising prices. When GDP numbers are released each quarter, markets listen. A surprise to the upside can boost equities and risk assets. A miss, or worse, a negative reading, can spark fear and volatility. Segment 2: Inflation explained for investors. All right, moving on to inflation, one of the most talked about and most misunderstood economic forces. Let's break it down. Inflation is simply the rate at which prices for goods and services increase over time. If your morning coffee cost $2 last year and $2.20 today, that's 10% inflation. But here's the thing, it's not always bad. In fact, moderate inflation, say around 2% annually, is a sign of healthy economic growth. It means demand is strong and people are spending. But when inflation spikes, that's when things get tricky. Too much inflation erodes purchasing power. It makes your savings worth less. It eats into corporate profits. And it usually forces central banks, like the Federal Reserve, to raise interest rates to cool things down, which we'll talk about in just a bit. On the flip side, there's deflation when prices fall. Sounds good, right? But not so fast. Deflation usually means demand is weak. Businesses are cutting prices to survive, and economic growth is stalling. Not a great environment for investors. Now, there are a few different types of inflation. Demand pull inflation, where too many dollars are chasing too few goods. Cost push inflation, where rising production costs, like wages or raw materials, drive prices up. And built-in inflation, which is kind of a loop. As prices rise, workers demand higher wages, which raises production costs, which pushes prices even higher. Key measures you should watch: the Consumer Price Index (CPI), which tracks the price of a basket of goods and services, and the Producer Price Index (PPI), which looks at what manufacturers are charging for their products. As an investor, you need to know how different assets behave in inflationary environments. Commodities, energy stocks, and gold, they tend to shine. Long-term bonds? Not so much. They get hammered as inflation eats away at fixed interest payments. Segment 3: Interest rates, the cost of money. Now let's talk about interest rates, one of the most powerful tools in any central bank's arsenal. In the US, the Federal Reserve sets the federal funds rate, basically, the interest rate at which banks lend to each other overnight. But this number influences everything: mortgages, credit cards, bond yields, and yes, stock prices. So, what happens when rates are low? Borrowing becomes cheap. People take out loans. Businesses invest more. Consumers spend more. It fuels economic growth and often a stock market rally. Now, when rates are high, it's the opposite. Borrowing costs rise, spending slows down, and the economy cools off. The Fed raises rates to fight inflation and lowers them to stimulate growth. This is where the macroeconomic puzzle starts coming together. If inflation is rising, the Fed might raise rates. That makes growth stocks less attractive because their future profits are discounted more heavily. Bonds lose value. Real estate slows down. As a trader, central bank announcements are must-watch events. One unexpected rate hike, or even just the hint of one, can send the market into a frenzy. Also, keep an eye on the yield curve. Normally, longer-term interest rates are higher than short-term rates. But if that flips, if short-term yields rise above long-term ones, that's an inverted yield curve, a classic signal that a recession could be on the horizon. Segment 4. Unemployment, the labor market signal. All right, let's round out the big four with unemployment, a major clue about where the economy is headed. The unemployment rate tells us what percentage of people who want to work can't find a job. It's a lagging indicator, meaning it confirms trends rather than predicting them. But it's still incredibly important. Low unemployment is usually a good sign. It means businesses are hiring, wages are rising, and people have money to spend. But, and this is key, if unemployment gets too low, it can fuel wage inflation, which leads to more general inflation, and that, again, could push the Fed to raise rates. High unemployment, on the other hand, means people aren't working, spending slows, corporate earnings fall, and recession risks increase. Keep your eye on the non-farm payroll report every month. It gives you data on jobs added, wage growth, and labor force participation. Markets react quickly to surprises in these numbers. Segment 5. How these indicators work together. Now here's where it all comes together. These indicators, GDP, inflation, interest rates, unemployment, they don't move independently. They're deeply connected. Let's play this out. GDP starts growing fast. More jobs are created. Unemployment drops. Wages rise. People spend more. That creates inflation. The Fed sees this and raises interest rates to slow things down. Higher rates make borrowing more expensive. Growth slows. Stocks pull back. The cycle resets. As a trader, your edge comes from connecting the dots faster than everyone else. If you see inflation ticking up and the Fed sounding hawkish, that might be your signal to reduce exposure to growth stocks or shift into defensive sectors. Macroeconomics helps you predict why markets move, not just how they're moving. Segment 6. Tools, resources to stay ahead. So now you're thinking, how do I use all of this in real time? You need a platform that lets you react quickly, analyze trends, and execute smart trades. That's where Crystal Ball Markets comes in. It's a world-class, cutting-edge, and incredibly user-friendly trading platform. Whether you're trading Forex, indices, crypto, or commodities, it gives you the speed, precision, and macro tools to stay ahead. Check it out at crystalballmarkets.com/platform and take control of your trading game. And if you want to keep learning, whether you're commuting or just chilling at home, subscribe to the Crystal Ball Markets podcast. It's beginner-friendly, no fluff, and packed with sharp insights on investing, macro trends, and the financial markets. That's rss.com/podcast/crystalballmarkets. Subscribe now. All right, folks, that's a wrap for today's episode of Financial Market Insights for Traders. I hope this deep dive into macroeconomics gives you more confidence and clarity in your trading strategy. Remember, understanding the economy isn't about memorizing definitions. It's about recognizing patterns, anticipating moves, and staying ahead of the curve. Until next time, stay sharp, stay strategic, and keep trading smart.